On May 15, 2026, something is happening at the Federal Reserve that most Americans will not hear about until they feel the consequences directly in their wallet. The chairman of the most powerful financial institution in the United States is changing, and the new man coming in has a plan, a fundamentally different plan, for how he intends to run monetary policy in America. Meanwhile, oil prices just spiked at the fastest rate we have seen in months. Inflation is climbing well above where it was just a few months ago, and the Federal Reserve just held its most divisive internal meeting since the early 1990s. Every single one of these developments is connected, and together they are creating a set of conditions that will directly impact your cost of living, your savings, your investments, and your financial future. Today, we are breaking all of it down, not the politics, not the headlines, the economic reality and what it means for your money. Welcome to Wealth Analysis Network, the channel that delivers deep, honest, research-backed financial analysis, so every person watching understands what is actually happening in the American financial system before they feel it. If you are new here, subscribe right now because every single week we bring you the kind of analysis that cuts through the noise and gives you the real picture. Today's video covers the Federal Reserve leadership transition, the inflation surge driven by rising oil prices, what the most divisive Fed meeting in over 30 years actually signals, and what all of this means for how you should be thinking about your money and your investments right now. Let's get into every layer of this. Let's start with what just happened at the Federal Reserve on April 29th, because it is more significant than most of the coverage suggests. The Federal Open Market Committee met and voted to hold interest rates steady, keeping the federal funds rate in a range of 3.5 to 3.75%. The vote was 8-4, with 3 members supporting the decision to hold rates but objecting to any language in the policy statement that suggested the Fed was still leaning toward future rate cuts, and 1 member, Stephen Moran, voting for an immediate rate cut. That level of internal disagreement inside the Federal Reserve is not normal. The last time we saw dissent this significant inside the Fed was in the early 1990s. And the reason the disagreement matters so much right now is that the two sides are not just disagreeing about timing, they are disagreeing about the fundamental direction of monetary policy. One side says the economy is slowing and needs stimulus through lower interest rates and more money in the system. The other side says inflation is the primary threat and needs to be fought through higher rates and a tighter money supply. The critical problem is that these two responses are not just different, they are opposite. You cannot simultaneously lower interest rates to stimulate the economy and raise interest rates to fight inflation. And right now the Federal Reserve is split on which emergency it is actually responding to. Inflation remains above the Federal Reserve's 2% target, while the war and surge in oil prices has upended the policymaking assumptions of the central bank and bond traders, who are now betting against another rate cut in 2026. The PCE inflation reading, which is the Federal Reserve's preferred inflation measurement, came in at 4.3% for the first quarter of 2026. To put that in context, it was at 2.7% at the end of 2025. That is a significant acceleration in a very short period of time. And here is the part that makes those numbers even more alarming. PCE inflation intentionally excludes food and energy costs. It measures everything except the 2 categories where Americans are feeling the most pain right now. When you factor in what is happening to gas prices and grocery costs, both of which are being driven higher by rising oil prices, the real inflation burden on ordinary American households is considerably worse than the official headline number suggests. Now let's talk about why oil prices matter so much, because the connection between oil and everything else in your daily financial life is more direct than most people realize. Oil does not just determine what you pay at the gas pump. It determines the cost of diesel, which determines the cost of transporting every product from every warehouse to every store in America. It determines the cost of fertilizer, which determines the cost of food at every level of the agricultural supply chain. It determines the operating cost of airlines, shipping companies, manufacturers, and logistics businesses. When oil prices spike at the rate we are currently seeing, It creates what economists call a cost-push inflation wave, meaning the cost of producing and distributing everything goes up simultaneously, and those higher costs get passed directly to consumers in the form of higher prices on nearly everything they buy. The people who feel this the hardest are the Americans who are already living paycheck to paycheck, and right now, that is the majority of the country. Credit card debt in the United States recently broke a new all-time record. Americans are already borrowing to survive. Higher prices on everyday necessities mean even less discretionary spending capacity, and less discretionary spending is what eventually translates into slowing corporate revenues, hiring freezes, and a contracting economy. This brings us to the single most consequential development in the American financial system right now, and that is the change of leadership at the Federal Reserve that is happening on May 15th. Jerome Powell confirmed at his final press conference as Fed chair that he will step down as chairman when his term expires on May 15th, while choosing to remain on the Fed's Board of Governors through 2028. Kevin Warsh, President Trump's nominee to replace him, is on track to be confirmed by the full Senate before that date. And the transition matters enormously because Warsh represents a genuinely different philosophy of monetary policy from Powell. Warsh has called for a regime change in the conduct of monetary policy, emphasizing his belief that the Fed needs to shrink its balance sheet significantly, down from approximately $6.7 trillion currently, which is still far above the $800 billion level that existed before the financial crisis. Shrinking the balance sheet means reducing the amount of money the Fed has pumped into the financial system, and that reduction puts upward pressure on interest rates, makes borrowing more expensive for businesses and consumers, and can create headwinds for stock market valuations. Warsh has also pledged to quickly cut interest rates, but he told senators he would act independently and not take marching orders from the president. The combination of these positions creates a picture of a Fed chair who is simultaneously hawkish on the balance sheet and potentially dovish on rates, and the market does not yet know how those two forces will interact under his leadership. One economist noted that Warsh is in the unfortunate position of probably being the least influential Fed chair in a long time, because he is going to have a very hard time convincing the other members of the rate-setting committee to cut rates quickly given the current inflation environment. Interest rates are set by a 12-person committee. The chair gets one vote. And right now, 3 of those voters explicitly said they do not want any language suggesting rate cuts are coming anytime soon. Warsh can set the agenda and the tone, but he cannot dictate the outcome. What he can do, and what financial markets are paying very close attention to, is signal a new era of policy that changes how investors, businesses, and consumers anticipate the future direction of monetary conditions in America. So what does all of this mean for your money? Let's be direct. There are 2 simultaneous realities that every financially aware American needs to hold in their mind right now. The first reality is that uncertainty is elevated. The Fed leadership is changing. Oil prices are elevated, and the geopolitical conflict driving them shows no clear near-term resolution. Inflation is running well above target by every realistic measure. And the internal disagreement at the Fed means we genuinely do not know with confidence whether the next major policy move will be a rate cut to address a slowing economy or a rate hold, or even a rate increase to address persistent inflation. Markets hate uncertainty, and elevated uncertainty typically means elevated volatility, which means larger swings up and down in asset prices in both directions. The second reality is that volatility and opportunity are the same thing from 2 different perspectives. Look at what has happened every single time major uncertainty has created a significant market decline over the past several years. When tariff announcements crashed markets in February of 2025, the people who bought into that decline saw markets recover to new highs within days. When Liberation Day tariffs triggered the fastest global stock market sell-off since the pandemic in April of 2025, the people who held and continued buying saw another recovery to record highs within days. When geopolitical conflict in the Middle East triggered sharp market declines in 2026, markets bounced back to record highs again. This is not a guarantee about what will happen next, Markets can and do stay down for extended periods. Recessions happen. Prolonged bear markets happen. Nobody, and I mean nobody, knows with certainty what markets will do tomorrow, next month, or next year. Anyone who tells you otherwise is not giving you analysis. They are giving you a guess dressed up as certainty. What history does show clearly is that for long-term investors, people who are investing toward a goal that is 10, 20, or 30 years in the future, short-term volatility, even significant volatility, is almost completely irrelevant to the final outcome. The people who built real wealth through every period of market uncertainty in American history were not the ones who perfectly timed their entry and exit points. They were the ones who stayed invested, continued contributing through downturns, and refused to let fear drive their financial decisions. Warren Buffett has made this point consistently across decades. Be fearful when others are greedy, and greedy when others are fearful. Time in the market always beats timing the market, because the people who wait for the perfect moment to invest always miss some portion of the recovery, and missing even a small number of the market's best days over a decade can cut your total returns by half. So here is what this moment actually calls for practically. Get your financial house in order because we do not know how long elevated oil prices and inflation pressure will persist. If the Middle East conflict extends, expect higher costs of living for longer. That means having a real emergency fund, not just savings mixed into your checking account, but 3 to 6 months of living expenses in a dedicated high-yield savings account earning real interest. Know what you want to invest in and why, because when volatility creates a buying opportunity, the worst time to figure out your strategy is in the middle of the panic. Have a plan before the noise arrives. And if you are investing for the long term, the right response to market uncertainty is almost never to stop investing. It is to continue systematically, perhaps buying in phases on the way down if markets decline further, and to hold your positions through the turbulence that is a normal and expected feature of every market cycle. The Federal Reserve is changing leadership at the most uncertain monetary moment America has faced in years. Oil prices are driving inflation higher than the official numbers fully capture. The internal disagreement at the Fed is the most significant we have seen in over 30 years. And Kevin Warsh is inheriting a situation where any major policy move, cutting rates too fast or holding too long, carries real economic risks. This is a moment that rewards preparation, not panic. Position yourself to withstand uncertainty and capitalize on the opportunities that uncertainty creates. That has always been the formula. And in 2026, it has never been more relevant. If this analysis gave you a clearer and more honest picture of what is actually happening in the American economy and financial system right now, please give this video a like and share it immediately with someone who needs to understand what is coming before they feel it in their wallet. Subscribe to Wealth Analysis Network if you are not already part of our community, because every single week we bring you the deep, honest, research-backed financial analysis that helps you stay ahead of the system instead of being surprised by it. Drop a comment below and tell me, what is your biggest financial concern heading into the second half of 2026? I read every single one. See you in the next video.